Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So my wife and I did a thing last week. We bought panels to cover all of our windows in the event of a hurricane. You know, these are the things you have to think about when you live in a coastal area. And we learned our lesson last year when we were scrambling at the last minute to find scraps of plywood to board up our house as Hurricane Milton approached. And, we managed to piecemeal it together, but it wasn't good. So we vowed not to have that stress the next time around. So all of these panels, they're really cool. They're not wood. They're made of almost this plastic fiber stuff. It's supposed to be wind resistant up to 175 miles per hour. And they'll be pre-cut with holes, pre-drilled. All we'll have to do in the event of a storm is put them up. It'll basically turn a full day project into about a 1 hour project once we get it all set up. Now, it's kind of wild. A lot of people that live in this area have made absolutely no hurricane preparations. I mean, at all. We're probably a little bit on the obsessive side, to be honest. Not everybody's going to pre-cut hurricane panels for the windows. I get that. But, for most people, well, not most, but for a lot of people, when the next storm approaches, they're going to be scrambling to buy water and food and batteries and, wood to board up. And I'll be honest, I've never been very good at prepping, but we've always at least had some semblance of a hurricane kit. It's wild to me that people living in a place prone to these storms haven't done anything to prepare for one first. And it does make for a lot of entertainment if you go to the grocery store when there's a storm approaching. But, I guess that's kind of human nature, right? We're really good at closing the barn door after the horse is out, but we're not as good at taking the proactive steps to keep the horse in the barn to begin with. And I think this goes to financial planning as well, right? According to the Federal Reserve survey of consumer finances, over half of American households, 54%, say they have no dedicated retirement savings at all. And, I bet the situation is even worse if you ask people if they have made any preparations or have any contingencies for a major financial meltdown, hyperinflation or a currency crisis or something to that nature. Heck, the fact of the matter is most people can't even cover an unexpected expense like, an appliance dying or their car breaking down. According to a U.S. News survey, 42% of Americans do not have any kind of emergency fund. And I think that this kind of live in the moment attitude spills over into a lot of Americans' perspective on gold. Because think about what gold is. It's widely regarded as a safe haven asset, right? Now, we know gold is money. If you listen to this show, you understand that gold is money. It has been money for 5,000 years. It continues to be money. But most people, at least in the United States, don't seem to really view gold as money. They view it as a commodity, a valuable commodity, and a lot of Americans recognize the investment value in gold, but I don't think that there's a mental mindset where, this is money. And so given that, why would you expect people that aren't big on, planning for contingencies to be really into a safe haven asset, right? We don't need that. We're chasing yield. We're going for. I was about to say we're going for the gold. We're not going for the gold. That's the kind of strange thing. But I do get it, and I think for a lot of people, it's hard to spend money, on something you may never need. Right? Buying hurricane panels for your windows, not cheap. Buying gold to hedge against inflation, not cheap. And I think a lot of people get caught up in the stock market and, they want to make that money, right? They want to be able to grow their wealth. And there's really not much of a way to do that anymore without a significant amount of risk. And gold is not considered a risk asset. That's not really its job. But I'll tell you this, The likelihood of another major bout of inflation. I mean, I'm not talking necessarily about hyperinflation, but just the type of inflation we saw a few years ago, or a major economic meltdown, a big recession. I mean, we're due for a recession, right? Or a currency crisis. We see de-dollarization in the news all the time. That doesn't necessarily mean that the dollar is all of a sudden not going to be the world's reserve currency, but there are problems in the undercarriage of the financial system, especially for the dollar. And I would say that the odds of all of these things are a whole lot closer to 100% than zero, right? So it behooves us to be prepared financially for these types of things. And that's really one of the reasons that you want to hold gold. I mean, first, in my mind, you want to hold it because it preserves your wealth, right? Your dollars are devaluing every minute. As I'm sitting here talking to you, the purchasing power of your money is going down. So you can shield your wealth from that by holding gold. But gold is also a great safe haven asset. It's going to hedge your portfolio against these crisis situations because it tends to do well in those situations because, after all, it is money, right? And one of the things is, again, I think a lot of people think, well, I don't know, I can't invest in that. I'm barely paying my bills. That's why I love the installment plan that we have here at Money Metals Exchange. You can actually start investing in gold and silver with as little as $100 a month. You dedicate that $100 a month to your portfolio each month. You purchase gold and silver. It's stored in our vaults, and you can build that safe haven over time. You can build that security over time. You can build your wealth preservation strategy over time. And then when there is a meltdown, you can rest easily while everybody else scrambles, right? You won't be like the guy fussing in the empty water aisle at Publix as the hurricane approaches. So check that out. You can go to moneymetals.com and check out that installment plan. And I'll link to that also on the show notes page at moneymetals.com/news. But anyway, make no mistake, gold and silver are safe havens. And in fact, right now, they look like the last safe haven standing because I tell you what, the bond market is a mess. And I want to talk about that a little bit because there's a lot of ramifications to what we're seeing in the Treasury market. And bonds, especially U.S. Treasuries, right? U.S. debt. They've been considered a safe haven for a long time, right? The mentality is the U.S. government is always going to be there, and if you invest in U.S. debt, you're going to get paid back, right? It's a safe asset to hold. And typically when we've seen a lot of turmoil in the economy globally, treasuries have done well. But over the last several months, they've not been behaving as a safe haven at all. In fact, during the early stages of the new tariff policy after Liberation Day, when the markets were selling off and everything was in upheaval, treasuries actually sold off while gold and silver both rallied. And that's unusual, right? You would expect treasuries, you would expect bonds to do well in those times of uncertainty, and they did not. They did not behave like a safe haven. And really, I think this underscores deeper problems in the treasury market and more broadly the bond market, because the treasury market has an oversized impact on the bond market. And there was another warning sign last week. Uncle Sam held an auction, and basically the world just yawned. If you look up news reporting on this 10-year Treasury auction that the U.S. Treasury held last week, you'll see that a lot of analysts described it as soft or weak. And basically, in a nutshell, investors snubbed the federal government, forcing bond yields even higher. In other words, they basically drove up interest rates on the long end of the bond curve. So, in other words, the world is less and less interested in lending the federal government money. It is becoming more difficult for the U.S. government to offload all of these treasuries, and it has to, because it has to continue to borrow because it can't stop spending. To that point, as of August 11th, the U.S. national debt has gone over $37 trillion, and that's just the debt held by the public, right? That's the borrowing. That doesn't even get into all of the unfunded liabilities that are out there. So, I mean, when you factor that in, and we're looking at outlays in the trillions of dollars to cover all of this debt. So, the borrowing's not going to stop anytime soon. Even if the government was to balance the budget, which, not going to happen. But let's just pretend, all of a sudden we got this surge of fiscal responsibility and they managed to balance the budget and only spend what was coming in. The U.S. government would still have to borrow billions of dollars because all of that Treasury debt rolls over, right? And when it rolls over, the government has to borrow more. Basically, if you borrow money from the U.S. government, when it's time for them to pay you back, they have to borrow money from somebody else to pay you back. That's the situation that the U.S. government is in. This weakness in the Treasury market and the ever-rising interest rates is a big problem for a country that depends on borrowing to finance this massive spending problem. So I'm going to kind of try to explain the nuts and bolts here a little bit of a Treasury auction. This is not something that your average person knows about, and I didn't. I had to do a little research to understand all of this. But so basically, when you have a Treasury auction, it begins with an expected yield. And it's basically a market forecast. They do almost like polling with these banks and stuff. And they kind of say what they expect the opening interest rate to be on a bond. So the when issued interest rate for last week's 10-year Treasury auction was 4.244%, 4.244. And as it turned out, the yield that ended up being kind of the final yield on that auction was higher at 4.255%. And this is known as a tail, when the final yield is higher than the when issued yield. They call that a tail. And it basically means that the government had to sweeten the deal and offer investors a higher yield than expected to entice them into the market to buy these bonds. So, in effect, the tail spread is the difference between the highest yield accepted and the when issued yield right before the auction closes. So a large tail signals weak demand, and it just means that the bidders required a higher yield than expected to buy the bonds. And big picture, this tells you that the market is uncertain or cautious about buying these U.S. Treasuries. So it was a 1.1 basis point tail. It was the first tail in about 6 months on a 10-year Treasury auction. And, it's not a lot, but it's significant, right? In the simplest terms, the government ended up paying a higher interest rate than anticipated to borrow $42 billion. That's how much this auction was meant to raise, $42 billion. So the way this worked in practice, to raise the effective yield, the government sold each treasury for an average of $99.60 instead of $100. So basically, kind of shaved 40 cents off of every bond. As one analyst for the Stock Market News put it, this might not seem like much, but in the bond world, it screams, please just take these, right? And the higher yield wasn't the only bad sign at this auction. There's also a metric called the bid to cover ratio, and it was the lowest of the year. This metric is calculated by dividing the total number of bids received during the auction. So how many bids did you get for these treasuries by the number of securities offered for sale? And basically this metric reflects the demand for treasuries. It tells us how many times the offered amount could have been sold based on the number of bids submitted. So in effect, the federal government wanted to borrow $42 billion. It received $98.7 billion in bids. That compares to $112 billion at the last 10-year auction before this one. As Stock Market News explained, this isn't just about weak raw numbers. Quote, it's about momentum. Investors are getting pickier. And you see that in the kind of the way that this auction was spread out, who bought these bonds. Foreign buyers were once again notably absent from this auction, and this has been a recurring theme really since the Russian invasion of Ukraine. I think a lot of foreign investors looked at the way the U.S. and the West sanctioned Russia, froze their assets, and they're saying, you know what? We're going to shy away from these things that can be used against us if we happen not to fall in line with U.S. policy desires. And that's just a reality. We've talked a lot on this show about this trend of de-dollarization, and this is part of it. Foreign buyers are buying fewer U.S. Treasuries. So in this auction, overseas investors bought 64.2% of the bonds, which sounds pretty good until you know that it was down from 88% in April. So a significant slowdown in foreign investment in U.S. debt. Buying from U.S. investors and mutual funds was also weak. So individual investors, mutual funds bought fewer of these bonds than you would normally expect. Primary dealers, so these are the big banks, so JP Morgan, Citigroup, they carried the load in this auction. Now, here's the catch. They're legally required to participate. They have to buy these treasuries based on their position as quote-unquote primary dealers. So that's where we are, right? Nobody wants this stuff except for the people that are required to buy them by law. It's also notable that the Federal Reserve bought $14.25 billion of these bonds. So a pretty significant percentage of that total. And it's notable because even though the central bank is right now shrinking its balance sheet, right? It's not engaged in quantitative easing. It's not actively seeking to expand its treasury holdings. It still steps into the market to buy treasuries, right? Because the bonds that are on the books right now at the Fed, some of these bonds mature every month. And when they mature, basically the Fed rolls them over. They go out and they buy a new bond to replace the bond that has matured because they don't want that balance sheet to shrink too quickly. And pretty soon, honestly, they're going to not want it to shrink at all. So in other words, even when they're not running quantitative easing operations, the Fed still has its thumb on the bond market, right? It's creating artificial demand and it's keeping interest rates lower than they otherwise would be. So even now, when the Fed is not really engaged in aggressive monetary policy, it is still, in effect, manipulating the bond market. And this is why I say the Federal Reserve is the engine that drives the biggest government in history. Because if it weren't for the Fed, if it weren't for its ability to print money out of thin air, if it weren't for its ability to just walk into the market and buy treasuries that it really doesn't need, except for to manipulate the financial system, well, the federal government wouldn't be able to borrow and spend to the extent it does. And that means it wouldn't be doing as much stuff. The government would be smaller were it not for the Federal Reserve. So if you're a small government kind of person, your enemy is the central bank. So when you look at the big picture, you have to wonder, how long is it going to be before the Fed has to more aggressively intervene in the market? So the impacts of this kind of rippled through the Treasury market. After the auction, the yield on the 10-year in the open market moved up 2 basis points to 4.22%. The yield on the 30-year bond also spiked, rising 4 basis points to 4.813%. So these are really high yields given the kind of circumstances that we have in the economy right now. And it's interesting because we can go back. And there were signs of this issue a while back in the Treasury market when we saw interest rates on Treasuries rising even after the Fed cut its interest rate. And it kind of goes to an important point. The Federal Reserve doesn't have as much control over interest rates as you might think. It can control that short-term interest rate, right? It sets its Federal Reserve funds rate. When we hear that interest rate, that's basically what the Fed charges banks to park money at the Fed, to park their reserves at the Fed. And this is an important thing. It impacts the entire interest rate environment. But it's much less impactful on the longer end of the curve. And you can have the Fed cutting rates on the short end and still see rates rising on the long end. And it'll be interesting to see because, we got our CPI data for July. And in the article I wrote, I'll link to it on the show notes page. I basically compared the data in this CPI report to cold oatmeal, right? It wasn't really good news, wasn't bad news. You could eat it, and it would give you sustenance, but it was nothing exciting. It was a very mixed CPI report, but it's being interpreted as really good for inflation. They are calling it a cooler than expected inflation report. It's not really that cool. I mean, core inflation is still over 3%, which is more than 2%, which is the target, right? It's been that way for a long time. The Fed has never gotten price inflation under control. It's really interesting to look at that core over the last couple of years. Core inflation did come down and pretty significantly, but then about a year and a half ago, it kind of settled in around 3%, and that's where we've been. I've argued for a long time the Fed never did enough to really tackle price inflation, and I think that bears out when you look at the results. They got part of the way there, and then they just kind of quit. But I mentioned this earlier. This isn't the first sign of trouble in the Treasury market. Going back to Treasuries, I didn't mean to get too in the weeds on the CPI stuff, but several analysts that I really respect, most notably Jim Grant and Jordan Roy Byrne, both of them believe that we're in the early stages of a secular bear market for bonds. And they point out that bonds have historically been subject to very long cycles, like 40 to 50 years. And we had a very long cycle of bullishness in bonds. We had very high bond prices and low yields. And that seems to be turning around. And both Grant and Byrne believe that we're going to see this coming for the long term, for the next 20, 30, 40 years, where we see higher yields. That's really bad for the federal government, by the way. I'll link to a couple of articles in the show notes that kind of dive deeper into those technicals. But here's the thing. Ebbing demand for U.S. debt is a significant issue for the federal government. I've said this a couple of times. Why? Well, it has an out-of-control borrowing problem. It has to borrow money. And so if people aren't willing to lend somebody money that needs to borrow money, well, that's a problem, right? So I mentioned the fact that the bond yields actually spiked as the Fed was cutting interest rates. When the central bank dropped interest rates by 100 basis points, long-term Treasury yields spiked by over 100 basis points. And at the time, Wolf Street, which is a pretty good analyst, Wall Street noted there are rising concerns in the bond market about the ballooning U.S. debt and about the flood of new supply of Treasury securities that the government will have to sell in order to fund the out-of-whack deficits. Treasury buyers and holders are spread far and wide, but higher yields may be necessary to reel in the mass of new buyers needed, even as the Fed is shedding its Treasury holdings through quantitative tightening. That sums it up, right? That explains why a lot of people are kind of shunning U.S. debt. There's too much of it, and there's going to be more. And how much of this do you want to hold on to, right? It's like you've got your drunk uncle that keeps coming to you to borrow money. At some point, you're like, sorry, drunk uncle, you're cut off, right? And more concerning is the fact that during several periods of geopolitical instability, Treasuries have sold off. And I mentioned that before also. We saw that on Liberation Day. That indicates that U.S. bonds might be losing their status as a go-to safe haven. Earlier this year, analyst Artis Shepard called the situation in the Treasury market, quote, red light blinking. He said, quote, the bond market is sending a message to the U.S. government that its spending is out of control and the reserve currency privilege it has abused for the last 80 years is running out. Lower demand for debt also, of course, means higher borrowing costs for Uncle Sam. And, interest on the national debt cost $144.6 billion in June. 1 month, $144.6 billion the U.S. government had to fork out just to service its interest expense. That brought the total interest expense for the fiscal year to $921 billion. That's 6% over the same period in 2024. And by the way, 2024 had a significant increase in interest expense. So far, in fiscal 2025, the federal government has spent more on interest on the debt. Think about this. The federal government has spent more on interest on the national debt than it has on national defense, than it has on Medicare, There's only one spending category in the whole entire federal government that is higher than interest on the national debt, and that's Social Security. Uncle Sam paid $1.13 trillion in interest expense in fiscal 2024. It was the first time interest expenses ever eclipsed $1 trillion, and projections are for the interest expense to break that record in fiscal 2025. It's certainly going to happen. And this is clearly an untenable situation, right? I've already mentioned that the Federal Reserve is the only player on the field that can significantly shift this momentum. But to do so is going to require a return to quantitative easing and expanding the Federal Reserve balance sheet. And of course, what does that mean? More inflation. Because when the Federal Reserve buys bonds on the open market, it does it with money created out of thin air. That money is injected into the financial system. That is by definition inflation, and ultimately rising prices will follow that. And Shepard said he thinks this is the most likely scenario. He wrote, quote, "A rational response to recent events would be for the U.S. government to cut spending, return to a semblance of sound money, and more generally, begin to scale back the level of its involvement in the lives of everyday Americans. That is about as likely as the fox guarding the henhouse. More probably, guided by the dominant and ignorant Keynesian model, a new cycle of quantitative easing will arise, forcefully but temporarily driving interest rates down until inflation comes back even stronger. If it continues on this path, the U.S. will dig itself deeper into this hole until it is buried in it." And that's the cycle. We've seen this cycle, right? The Fed jumps in, it does quantitative easing, it stimulates the economy, it buys all of these bonds, it props up the stock market, it blows up a bunch of bubbles, it incentivizes a bunch of debt, the whole thing breaks down and falls apart, and then the Fed repeats that process. Eventually, it's not going to be able to blow the bubbles back up. That's the bottom line. So you may want to take Treasuries off your go-to safe haven list. And so what does that leave? Well, gold and silver. Now, some people understand this, right? We know that there are a lot of central banks right now that are piling up gold and silver. Poland has kind of led the way, but China, India, the Czech Republic, there are a lot of countries that are stocking up gold. And it's really interesting to kind of look at the real-life examples of how some countries have used gold to hedge against economic threats. Iran is a great example, and so is Russia. Now, before I delve into this a little bit, let me be clear and emphasize that I'm not saying that, oh, it's great that Iran and Russia is evading sanctions and supporting its economy using gold. Don't take this as some kind of pro-Iran or pro-Putin position. I'm simply saying that the Iranians and the Russians were smart to have gold, and it's paid off for them. And it has served as a lifeline for their economy. And from a geopolitical perspective, that may not be great, but it shows the power of having sound money. And it provides a really good example for us to study because there are a lot of lessons to be learned here. The bottom line is gold represents financial security even when the entire world is against you. So I've written a couple of articles about how Russia has used its extensive gold holdings to keep its economy afloat. I'll link to one of those, at least in the show notes. And this is in the midst of aggressive Western sanctions after it invaded Ukraine. And recent reports indicate that Iran has kind of been doing the same thing as it's faced global sanctions over its nuclear programs. Through the first 6 months of the Iranian calendar year, they've got an odd calendar, so their first 6 months run from March 21st to September 20th. I don't understand that at all, but that's what I'm told. But during that 6 months, Iran imported 43 tons of gold, valued at $2.5 billion. This is according to customs reports. That was a six-fold increase compared to the same period in the previous year. According to the World Gold Council, Iranian gold imports exceeded 100 tons, worth over $8 billion in 2024. This was like 11% of the country's total imports. According to Iran International, it's an English language Iranian news source. The increase in gold imports, quote, may reflect broader efforts by the country to shield its economy from currency shortages and manage international trade amid sanctions. So in other words, the country is using real money to keep its economy going because the fake money, the fiat money, is not doing its job, right? It's either been sanctioned, they can't get dollars, and their own currency is in a mess. I read an article the other day that they're talking about just like subtracting zeros from the currency. That's how much inflation they have there. So like they're going to, make 100, whatever their currency is, 100 note into a 10 note, just lop off a zero. So their fiat currency isn't in good shape either, but they are getting gold. That Iranian English language news site asserted, quote, gold has become a key safe haven asset in Iran as the country navigates sanctions, currency volatility, and political uncertainty. Former Iranian bank chief Hossein Maharrey, probably butchered his name, but that's close. He said gold vaccinates the Iranian economy against global sanctions, and he dismissed concerns over a possible snapback of sanctions under the 2015 nuclear deal. Quote, even if this mechanism is activated, it does not mean the collapse of the country's economy. For 46 years, we have withstood Western pressure, and the country has become, in a way, vaccinated against them. So it's vaccinated by gold. The Iranian government has encouraged the flow of gold into the country. According to media reports, officials have allowed some exporters to import gold instead of repatriating foreign currency. So what this means is typically an exporter is going to receive payment in a foreign currency, right? If let's say Germany, we buy some stuff from Germany, they're going to get dollars, right? And dollars are often involved. Dollars are the world reserve currency. So a lot of trade is done in dollars, and then it's converted to local currencies after the fact. So basically, these foreign currencies, let's say that Iran gets dollars somehow. These foreign currencies are then held in the Iranian banking system as a reserve. Instead of doing that, what the government is doing is they're allowing exporters to use foreign currency to buy gold. So if they get euros for something, they'll take those euros and buy gold, which then is held as a reserve instead of that foreign fiat. This keeps those reserves, if they have euros and dollars, those things can be frozen, can't freeze gold, right? It really enables Iran to easily sidestep sanctions and manage its reserves. And, it also creates economic security. Foreign governments, they can freeze assets denominated in their own currencies, as I just mentioned, and they can't freeze gold. It is money. And the thing is, it's recognized and accepted as money worldwide, right? I may go to China, they might not want dollars. I might go to Europe, they don't want yuan. I can go anywhere and people are going to take gold because everybody recognizes gold. It is truly a global currency. Interestingly, Iran has also used gold to directly conduct transactions. A sale of drones to Russia was recently partly paid for with bullion, according to some documents that were obtained by hackers. Russia paid Iran approximately $1.75 billion in a deal for these drones. And part of that payment was made with several tons of gold ingots. So using gold as money, literally as money. And we've seen this in Russia too. They've also, this transaction was with Russia. So, but Russia has done that with others as well, buying oil from India, in fact, using gold as part of that transaction. So they're basically locking dollars out of the system. They're just going straight to that real money. The Iranian people also gobbling up gold as they deal with their own country's monetary debasement. I mentioned the fact that they're talking about just removing zeros from their currency in order to deal with the very near hyperinflation that they're facing in that country. According to World Gold Council data, gold coin and gold bar purchases in Iran surged by 20% in the second quarter of this year. Meanwhile, gold jewelry demand grew by 12%. And it was the only market in the entire world that reported an increase in gold and jewelry sales. If you look at the global numbers, jewelry sales fell about 14% year on year in the second quarter. And this is basically just being caused by record high gold prices, right? Jewelry, kind of a luxury item. Obviously, it's a price sensitive type of thing. When money gets tight, you're not going to buy jewelry. So jewelry sales have fallen across the world, but not in Iran, because they're actually buying this gold jewelry as an investment, as a security. And it's important to understand that in countries like Iran, India, China, when we talk about gold jewelry, it's not exactly the same as it is here in the United States. Their gold jewelry tends to be of a higher purity. So in the United States, you would tend to get 14 karat gold, maybe 18 karat gold. Typically in these Asian countries, you're looking at 22 karat gold chains. They're more of an investment. Not the perfect investment, because they're not completely pure. It's not the same as having a gold bar or a gold coin. But especially like in rural India, these gold chains, these are their savings. They're not just for adornment. And I'm certain that that's why you've seen this surge in the sale of gold jewelry in Iran. People are buying it as a way to protect their wealth from the manipulation and depreciation of their currency by their government. And at Money Metals, we actually sell a line of this higher purity gold jewelry, 22 karat chains, bangles. You can check those out at moneymetals.com if you're interested. Great gift for the wife. You know, you can buy her a nice gold chain and know that, you know, it's something that will hold its value, unlike maybe the 14 karat gold piece that you're going to take to a pawn shop in 20 years. And they're going to be like, we don't want this. So something to check out, something to think about if you're, especially if you're in the gift giving mode. So yeah, gold jewelry on the rise in Iran. And, here's the bottom line. Despite their best efforts, the West has found it difficult to stop countries like Iran and Russia from using gold due to its fungible nature. It's easy to exchange, right? And there's a global demand for the precious metal. As I said, you can go anywhere in the world from, North Korea to Brazil, and people are going to say, yeah, I'll take some gold, right? They recognize its value. Gold is money. And it's recognized as money everywhere. And even if they don't want dollars, even if they don't want some fiat currency, everybody wants gold. And again, not trying to justify these countries' wartime policies. It just underscores the nature of gold as money and its important role in the global economy. When fiat currencies are cut off, when they fail, when they depreciate, when they're manipulated, gold will always remain a viable alternative. And this is why you want to have some, right? This is precisely why so many countries are accumulating gold at such a rapid pace. And it's something that you want to consider for yourself, I believe, right? Other countries have recognized the power of gold and the risk of holding dollars, and it is a lesson that individuals should also take to heart as well. You need real money. So I say this every week. It's a great time to call Money Metals, talk to a precious metals specialist. The number is 800-800-1865. I say it every week, but it's true. These folks are fantastic. They can help you figure out how gold and silver can fit into your investment strategy. They can tell you about things like the program that I mentioned, where you can build your gold or silver portfolio using installments. So a lot of information. Give them a call, 800-800-1865. Even if you don't want to talk on the phone, that's cool. Go to moneymetals.com. You can chat with a precious metal specialist online in a chat. Or if you know what you want to buy, you can purchase all of the things that we sell right from our very easy to use web platform. So visit Money Metals Exchange today. Get real money. Protect your wealth. Have those hurricane shutters ready for your windows, right? You can't buy your insurance when your house is on fire or blowing down in a hurricane. So do that today. So that's a wrap for this episode of the Money Metals Midweek Memo. You can get more information about all of the things I've talked about on the show today and more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up for our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you can tune into our Market Wrap podcast every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. This week, I'm going to be talking to Jeff Clark, so you'll want to check that out. Thank you so much for listening to this show. I really do appreciate it. I know there's lots of choices out there. If you like this show, please do me a favor. Give us a good review on your podcasting platform. Crush those like buttons. Share the episodes. We really, really do appreciate it. Thanks again for listening, and I will be back to talk to you again next Wednesday.